thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We discuss what's impacting mortgage rates on a daily basis, whether it sometimes comes from the economic calendar or a combination of that with headline news or geopolitical. Sometimes it gets even really confusing out there when good news is now bad news because market sentiment has changed. So we try to get into giving the nitty gritty of what's driving the markets and what's on the minds of investors that are moving the markets in certain directions. So we try to get that information out to you guys. A little bit about myself is I'm a loan officer. I work as a loan officer at a national lender. We do lend in all 50 states. If I could be of any service to you, of any refinances or purchases, I would love to be able to earn your business, so please reach out. Otherwise, I would like to be a resource for you folks as well. So if you guys get questions about anything, again, please feel free to reach out. We'll be more than happy to try to get the information you're looking for. So without further ado, we'll jump right into the report. We'll start off with the economic calendar. Today, we had a couple different things going on in Europe that did have some impact with our markets. The Bank of England came in expectations, did raise a quarter point on their rates. But the big surprise actually was the Swiss National Bank came in and did a half a point hike. And that kind of caught the markets off guard and then kind of disrupted them early on. Now, we also got, now back to our own data here, we do got housing starts that came in. And we'll just go with the percentage because it'll be a little bit easier. But we did have a revision to the April numbers for the housing starts. Instead of being down 0.2%, it was up 5.5%. And then, however, the other effect was for May, it dropped 14.4%. So it went from 1.81 million down to 1.549 million. So obviously there's a big lag in construction. On the other one, we got future housing starts, which is building permits. It went from being down in 3% in the month of April to being down 7% in the month of May here. So as you can see, it went from 1.823 down to 1.695 from 1 month to the next month. Now we got the Philly Fed index. This is the manufacturing in the Philadelphia region. So it was up back for June, and in May's numbers it was up 2.6 on the index. And forecasts showing that it was supposed to go upwards to 5.5. However, it dipped. It contracted to 3.3 in the index here. So that's two so far that we've seen this week. We had the New York region, now Philadelphia region, both showing contraction. And then, so obviously that's something we will need to monitor. Obviously, manufacturing seems to be there seems to be some issues going on with manufacturing here. Now, to move on, we got the jobless claims. So this last week's report was revised slightly higher from 229,000 to 232,000. Forecast called for 215,000, a bigger dip. However, it did slightly dip, but to 229,000. So pretty much unchanged from last week's first initial number, but because of the revision, it went down slightly by 3,000 jobs here. Continued claims, as you can see here, it went up. So last week's it was revised slightly higher, and even on top of that, the slightly higher number, it went up to 1.312 from the 1.309 number here. So this is something we'll have to keep an eye on. Jobs seem to be, we are seeing a slight uptick in jobs now with the rates going up and the economy and the projections. We may see more layoffs going ahead, and of course, that's what's kind of dictating the markets right now. Stocks are down, bonds, mortgage-backed securities are down, as you can see here. A lot of it is, as we talked about yesterday, the Fed is even strengthening their tightening. What was the concerning thing for them was obviously the CPI report last Friday was a concern, but also forecasts or expectations of inflation, especially from the University of Michigan's Consumer Sentiment Report. So they were a bit concerned about that as well. So because it came out with hawkish, more hawkish rhetoric, stocks them are of course worried about a recession, of course higher jobless claims. So those are the directions. So they think that a soft landing may not be feasible. It looks like it could be a hard landing into a recession at some point. When it could be we don't feel these effects of the rate hikes until about 6 months, so we may not see any initial stages of a possible recession until probably next year, but for most likely. But in any case, the Fed did indicate they could rate hike again by 75 basis points in July. If you saw the dot plot, it went from 1.9% expected for by end of the year to 3.4. So that means there are plenty of rate hikes, or at least larger increments, to be had with that expectation. To go from, right now we're at 1.75, so we're almost halfway there in terms of where we're at from the beginning of the year. So again, those are things they may try to get there sooner than later. Now, um, let's take a look here, see how the bonds are playing out here. Again, we start off lower in the day, even though we're up for the day, but we're down from where we left off yesterday. Yesterday, we actually had it helped us out a lot. It took off. We were actually closed up 131 basis points, so we made some ground. Right now, we're down 39 basis points. So we're off from where we closed yesterday, but we're still better than where we were beginning of the day type of thing. As you can see, this level we're at, we're getting kind of closer to where we were Monday, beginning of Monday, not where the close, but we're getting close to where Monday had started at. So of course we got a bit of a ways here to reach 25-day moving average, but hopefully this will be possible to get back towards in the near term here. And then yields, as you can see here, yields are almost about the same where we were yesterday. When I reported, it was about 3.33, and that's pretty much where we are if you round up at the 3.328, round up to 3.3 here. So lastly, let's touch on what the average rate is for conforming loan limits. Again, these are off by off a day based on yesterday's data, and we also are. They do have points built into them, so that's why you're not seeing the 1/8 increments on these. So the 30-year fix is down now to 6.03 after yesterday, and then 15 years down to 5.38%. So again, still much higher than where we were last week. However, better than where we were earlier this week. Now, if you guys are in the market looking to refinance or purchase, we do have some great programs. We have some ARMs that could help offset that. That are still in the 4% range that perhaps could help you guys. Please feel free to reach out and we can discuss those further. I can't get into too much details with the rates because being this a video, which I don't have APRs or the stuff like that. So for compliance reasons, I don't want to have any issues there. So again, please feel free to reach out. But if you guys like these videos, help us out. Smash that like button. We greatly appreciate you folks. In the meantime, we look forward to see you guys in tomorrow's video. Thanks so much for watching. You guys have a great rest of your day. Bye-bye.